Hey everyone, it's December 17th. The market just closed. We are going to be picking one of the 4 biggest gainers and one of the 4 biggest losers on the S&P today. So to check it out, you just go to marketwatch.com. Check up here at the top. Lennar is what I'm picking. They're a home builder. I'm going to pick them. MPC was the biggest loser. Now they're an oil company. I don't like looking at oil companies. I don't like looking at banks, insurance, utilities, or energy because I don't really understand how I like consistent cash flow. And in oil, a lot fluctuates based on the price of oil. So their revenues and cash flows can change drastically year to year. I don't like to mess with that. I don't really understand that very well. So I avoid it. Not saying you should. I'm just saying I'm a big believer in investing that you should stay within your circle of influence and circle of competence. And oil is not one of those for me. So let's get rolling on Lennar. So Lennar is a home builder. LEN, I believe, is their ticker symbol. It is. I'm here at Y Charts showing everybody. They're based out of Florida. They're the largest home builder by revenue in the United States. The company's home building operation target first-time move-up and active adult home buyers. I believe they also do multifamily management and build. So I don't think this is fully. Oh yeah, right here. Miami-based Lennar is also involved in multifamily construction. There you go. So we're going to go through the 8 pillars. As you can see, in the crash in 2008, they went from a peak of $60, $66 a share down to about $7.50 a share, $6.50 a share, and then have now rebounded back to 80. But in the March crash, they went as low as 38 or so. Let's check that out again. Ooh, 29. On March 23rd, they hit $29 a share. They're back up to 80 already after hitting a peak recently of 85. So is this an all-time high? I believe it actually is. So they're actually at an all-time high. So let's look at the company. $25 billion market cap. First metric, PE ratio less than 20. Historical PE overall for the market is 15. This is 10. So a green check mark there. Profit margin, 13%. So not bad. For the last year, it's a little over 10%, about 11%, with a gross margin of 18. So gross margin is for every extra unit they sell, every extra $100 they bring in revenue, how much of that's going to be profit added to the bottom line. So it's not a very high gross margin business. Home building tends to not be. So that's something they consider. Their dividend yield is 1.35%. So on $25 billion, that's roughly $250 and 0.3, so $325 million. Is that right? I think so. Call it $300 million bucks just to round it down. $300 million is what they pay every year in dividends. That's important when you look at the free cash flow. So the next metric we want to look at, we have 2 check marks so far. We want to look at their revenue growth. Last 5 years, 11 billion to 22 billion. That's doubled. Now let's see where they were in the 2008 crash. This is very important for looking at these building companies, home building companies. They hit a peak of 16.3 billion and got as low as $3 billion. That's an 80-some% drop, guys. Like that's a big number. But they are bigger now than they were before, so it makes sense why their stock is at a further high. Net operating income from $911 million, never forget, up to $2.5 billion. So that's a check mark there. Now, one of the things I've been adding to my analysis is looking at operating income. Operating income looks at the company's profit before debt payments and before depreciation and before any one-time charges and profit. It just shows the operating business, how much did it make? And it is increasing. It's up from 1.27 billion to 3.1. So we definitely have check marks there. Shares outstanding. All right, guys, we went from 223 million shares outstanding to 309. Okay, so in the last 10 years, you'll see 188 million to 309 million in shares. That's not a good thing. They're diluting their shareholders. What that means is shareholders who've been with them for a long time, 10 years, now are buying about 40 or 50%, 40% less they're getting 40% less of the profit and revenue they were getting before. I don't like it when companies do this. They try to do it just for acquisitions to grow. And this is a very cheap company relative to price to earnings ratio. So I don't know why they're issuing more shares. It's something to look at when you're researching this company further. All right, total cap. We want to look at the balance sheet. Total current assets being greater than total liabilities, total current liabilities. We have 20 billion. Keep in mind, of this 20 billion, 17 billion is inventory. That's something to keep in mind. It's that actual cash in hand. So we look at the 20 billion versus 1.7 billion. Oh my God. I mean, so the great thing is they only have 11.8 billion in total liabilities. So it doesn't look like they're going to go under anytime soon. Even if the market fell in their markets 30%, they still have enough money to sell off their assets at 30% less and still pay off all their debts with their cash. So this is a good thing. It's hard for companies like this to go under. That's what we're trying to analyze, is what are the chances of bankruptcy? It doesn't seem like that's very likely with such low debt amounts. So I like that a lot. Let's go look at the free cash flow number. The free cash flow is cash from operations less your capital expenditures. I'm glad that a company like this has a very little, they only pay about 6% of their cash from operations to capital expenditures. It means they don't have to reinvest back in their business a ton in order to grow it, or in order to maintain it. So let me figure out what I want to do is take the last 5 years of cash from operations and then take the last 5 years of capital expenditures and average them together for a free cash flow for the last 5 years. So let me add them up together. So the first metric is free cash flow, growth. It has definitely grown. They had negative cash from operations just 5 years ago, from negative 510 million to a positive 1.4 billion. So it's definitely a positive. Their average over the last 5 years has been $750 million in free cash flow. Now, the multiple. What multiple are you willing to pay to own this company? Over long periods of time, your free cash flow and your net income should be about the same, right? So if the historical average is 15 times for a company, and this company is going to have a lot of ups and downs based on the economy, and we're probably in the higher end of the cyclical cycle for homes, I don't want to pay a lower amount. But if we just do the historical average of 15 times, you're talking about $11.2 billion for the company. So let's go back here. And the company was selling for $25 billion. I think it's a little rich. So I'm looking at this saying, it might sound crazy, but I think you should wait for the stock to fall considerably in half because of the fact that it is a very cyclical business. I don't know a lot about the qualitative aspects, but this is part of the research you want to do. It sounds like an extreme. I'm sitting there basically telling you pay 5 times earnings. But I like to look at the cash flow over long periods of time. Now, the cash flow is up a lot over the last 5 years. So actually, maybe the argument may actually time out. I'm going to go back on this one. It went from that negative 420, that negative 510 million, definitely skews it. So maybe go a little bit higher multiple. Maybe it's a 15. The bottom line is I think 25 billion is still too much for it, for the market cap, and the stock is at $80. So maybe you go a little bit, maybe you sit there and maybe I'm interested around sub 60, sub 55. I don't know, but I do think that I'd have to understand how they do. Obviously, the recession of 08 and 09, they were in very fast-growing, hot markets that basically stopped. So who knows? But the bottom line is I think this is overpriced, but you're going to get a dividend. And by the way, the dividend is supported. They pay about $300 million a year in dividends, and last year they did $1.5 billion in free cash flow, and you use free cash flow to pay dividends, so it looks like that's safe. So anyhow, that's Lennar. Now the next company is HII. These guys dropped a lot today. Huntington Ingalls Industries. These guys are a aerospace and defense company located in Virginia. Military ships. So one thing to consider, Democrats tend to be less on military spending. I don't necessarily believe that, but the theory is that when a Democrat's in office, military spending is hurt or there's issues with it. Pay that for what you want, what you will, but let's just take a look at the company. Roughly a $7 billion company, 11.7 PE, check mark there. The profit margin is just under our 10%, so an X there, but again, none of these X's mean much by themselves. Gross margin of 19%, which makes sense. They're on government contracts. I imagine there's going to be tighter margins when it comes to how they show things. I still think government contracts are very lucrative, but either way, 2.6% dividend, which means on $7 billion market cap, they have to pay 182, call it $200 million to be conservative in dividends per year. So we want to make sure that their free cash flow is well over $200 million a year. All right, so we have one check and one X so far. Let's go to the next ones. Revenue growth. Revenue growth over the last 5 years is $7 billion to $8.9 billion, check mark there. Profit growth from $404 million to $549 million, check mark there. So we have 2 check marks on those ones. Shares outstanding. Let's see if you can see this. 48 million to 41.4, check mark there. So they're buying their shares back and treating their current investors better by doing that. Okay, total current assets, 2.9 billion. One thing I like is very low inventory, and total current liabilities is 2.2 billion. So it's 2.9 to 2.2. They have cash there to pay off all their current liabilities. That's a check mark there as well. I'm liking this so far. All right, free cash flow. So again, free cash flow is cash from operations less capital expenditures. So I'm going to add these 5 years of cash from operations, subtract out the 5 years of capital expenditures. Let's add this together. All right, adding them all together, the average about 490 million. So if you remember, we pay about $200 million in dividends. They can easily support that. Their free cash flow actually is down. It was an X on free cash flow. It went from 680 million down to 365 million. Their average about 490. So they're spending more money on their capital expenditures, as you can see. 10 years ago, it was about 200 million, and now it's gone up considerably. So one of the things you have to understand is, why are they increasing their capital expenditures? You need to figure that out, because that's taking free cash flow away from the investors and taking it from the company. It might be good free cash flow spending. It might be spending on growth, which is awesome, as opposed to maintaining. So here, one of the things to understand before you do this is, what are they doing with that free cash flow? So right now, I would say they're pretty reasonably priced at a $7 billion company. It's not terrible, but the aspects you want to understand is, what are they doing with that free cash flow that keeps decreasing? Why are they spending more on the capital expenditures? Is it maintenance capital expenditures, or is it growth capital expenditures? Are they spending to maintain their business, or are they spending to grow their business? If they're spending to grow their business, we love it, especially if it's working out, because they're operating. Let's see if their operating revenue was increasing. Their operating cash flow, Their operating cash flow was not really increasing, so maybe that's not what they're doing. But either way, that's my only downside of the company, is the decreasing free cash flow. The multiples are great. The profit margin's fine. Let's see how they did in previous recessions, just to see. Let's see. Oh, they haven't been public since 2010. So yeah, I like the consistent growth in the revenue. It's slow. Remember, when it's slow, you can't pay too much of a premium for the stock. And it seems like the premium's low because of 11 times PE, but the free cash flow is much higher. The free cash flow right now is roughly, even last year's PE, last year's free cash flow, it's almost 20. So it's higher for a very slow growing company with decreasing free cash flow. So remember, you have to consider these things as you go along. So anyways, subscribe. If you like this video, please like it. Please subscribe. Send it to your friends. It helps me pay the bills. It helps me with my addictions. So thank you very much. I'll see you guys tomorrow.